Hello everyone, this is Carbonomics. Over the past few years, investing in electric vehicles has been on the mind of almost every investor, especially when it seems like there's a massive push in the Western world to both electrify and decarbonize our existing systems. And how could we not think about electric cars with Tesla almost being a 20 bagger or more from 2019 to today? Well, this video is going to go over some of the problems associated with investing in electric vehicle companies. Yeah, and the point of this video is not that investing in electric vehicle manufacturers is necessarily a bad idea in theory. Um, it's just covering some of the reasons to think twice about it, why there are likely better options out there as well. So starting off with both the first and largest reason, it's simply that designing and selling cars is a bad business model. Now, what do I mean by this? Um, you can see it particularly in the company's profit margins. Tesla has profit margins of around 14% now, as they've increased profitability over the past year or so. And we can see that this is higher than, Ford, um, and higher than GM as well. But these margins are still poor overall. And ultimately, this isn't even Tesla's fault or any auto manufacturer necessarily. It's more just to do so with the nature of the industry they operate in. I get that everyone's infatuated with Tesla because of its high levels of growth, but the automotive industry is not really a great one to invest in. The creation of vehicles is a capital-intensive business model, meaning you need to spend, hundreds of millions or billions of dollars to build out these gigantic factories to produce these cars. Sourcing various materials with hundreds of suppliers, it really leads to operations growing in complexity and cost. And even with Tesla beginning to attain profitability recently, a large percentage of its free cash flow is because of carbon credits, not the profitability of electric vehicles themselves. This article is from July, so it's a little outdated, but the point made by the author is still relevant. As he says in the article, while Tesla's generated 10% of its revenues from carbon credits, this actually represents 50% of the company's free cash flow at this time, back in July, as they said. So even if subsidies are helping these car companies, do you really want to invest in a company because it's receiving support from the government? That can easily go away over time. Another reason why manufacturing cars is a bad business model, it's the cyclicality of the sector. Selling cars is a cyclical business where the industry operates in waves. Profitability is at its highest during bull markets and good economic conditions, while the business suffers dramatically when bull markets come to an end. We saw this firsthand in the 2008 Great Financial Crisis, where, if you recall, General Motors and Chrysler were given a $17 billion bailout to survive. Think about it. When are people buying cars? When they have excess money to spend, or they can afford to take on debt to own that car. No one's going to buy a car when they're struggling to take care of bills or funds begin to dry up. So car companies are really at the whims of broader economic environments. And the same goes for airlines, cruise ships, and other cyclical industries like this. There are many reasons I could mention why this is a poor business model, but I think you kind of get the point here. People want to hear about all the possible reasons why a business model is good or bad. I can make a separate video on that at a different time. Now, what is an example of a good business model? I'll point you towards an industry that I'm invested in as an example, commodity exchanges. Most of the commodity exchange business where commodity futures contracts are traded, um, like Brent or WTI for oil, for example, this is all done with software or online. So there's no need for a commodity exchange to, spend all the upfront capital, billions of dollars, on factories or warehouses. They also require significantly less workers to operate the software. There's also potential for recurring revenues or revenue made off of data on the exchange. So overall, there's significantly less capital required to operate this business model. Even better, high volatile environments actually help CME earn more. As more volatile moves in prices, meaning the more futures contracts are being traded at one given time, actually means that CME earns more in revenue from more trades. So the largest group of commodity exchanges is a publicly traded company called CME Group. And as you can see, the difference in the profit margins is quite vast between a company like Tesla and CME. We can see here they have a 60% profit margin, compared to the 14% Tesla has. Um, and Tesla's profit margin is actually higher for the automotive industry than some of the other players. But moving on to the second problem with EVs, one of the key issues for the mass adoption of electric vehicles is that we simply don't have the metals and resources to lower the costs of them. And this will be significantly limiting for the electric vehicle industry and how many cars these manufacturers will be able to sell. The overvalued stock prices we've seen in the sector are pricing in high levels of growth that simply won't happen because we don't have the resources to do so. Even with battery recycling ramping up, we would still need 336 new mines to produce the required graphite, cobalt, nickel, lithium, and other metals needed for these batteries. As the CEO of TechMet says here, we're heading toward an extreme cliff that, unfortunately, our industry needed to invest $100 billion 5 years ago to avoid. So investment has actually been down over the last decade, due to the grueling bear market in commodities. So we really have no idea where these metals are going to come from. And that is going to be a huge issue for the sector moving forward. According to the International Energy Agency, or IEA, EVs are requiring 6 times the amount of minerals compared to conventional cars. And the IEA also predicts the EV industry could need 6 to 30 times the current supply of key commodities, as you can see here. So it sounds like we will have persistent issues in bringing down the cost of electric vehicles, which will make it that much harder for the average consumer to make the switch to EVs. According to Kelley Blue Book, as of July, the average price for an electric vehicle was about $18,000 more than the average for cars with combustion engines. And this is only going to worsen as commodity prices continue to rise. So there's virtually no incentive for the average person to buy an EV, unless they're forced to do so, like in California and New York, with what they're trying to do with their 2035 mandates. But yet again, relying on demand from government mandates is really not the greatest situation to invest in, because these mandates can easily be reversed over time. Moving on to the last notable problem with EVs, in any industry that's developing with fast growth, like electric vehicles, online gambling sites, cannabis companies, and plenty more, it's really difficult to know who truly is going to win out in the sector. Ultimately, there's only going to be a few larger winners in any of these industries, and it's really not going to be easy to figure out which new EV companies will win, especially when the industry incumbents already have a massive head start in terms of resources and manpower. Tesla's advantage was a rare one, and that came from just how early they were to the electrification trend. But the new competitors entering the space now, they'll have to deal with the traditional combustion engine car companies like GM and Ford, who will be vastly better capitalized and qualified, than a new company entering the industry in all likelihood. It's really a steep hill to climb with large barriers to entry. Economics of scale are going to play a large role in this space as well, and car companies can burn cash for long periods of time before they really earn any profits. See Tesla as a primary example of that. In my view, if you're looking for disruptive companies like Cathie Wood and ARK Invest tend to do, you should ideally look for a company disrupting a more established industry. Not one where new competitors are emerging left and right, like in a sector such as electric vehicles. Although it is kind of an established industry as well. It's not that it isn't possible for your investment to work out, but there are definitely easier investments to make in my view that have a far higher probability of success. And I cover some of those investments that I think fit that bill on this channel. Well, that's going to be the end of the video. Let me know what you thought in the comments. If you liked it, please consider liking and subscribing, as it really helps out the channel. Thanks for watching.